Hey, what's up everyone, and welcome to the School of Personal Finance. So 2023, we went out with a bang. The market finished much higher. The S&P was up a little bit over 26% for the year. And a lot of people were on the wrong side of that trade. Many people were very bearish going into the end of the year, thinking that the market was going to fall off a cliff, and it did the exact opposite. So here we are, 2024. The market pretty much has gone nowhere in the first couple of weeks. We started out slow, and now it's kind of rebounded back to where it finished last year. But everybody's opinions, they are all over the map this year. A lot of people are calling for doom and gloom, thinking that we're about to hit a double top right here in the market from 2 years ago and head back down. Other people think that we're going to be off to the races, making new highs. So I wish I had the answer for you. I wish I knew where this market was going. But in this video, I'm going to share my opinion, which is all that it is, and also talk about some places where you could look to invest in 2024. I hope that you find this one helpful. Let's get to it. My quick disclosure, none of this is investment advice. This is all for educational purposes only. I don't have a crystal ball. I don't know where the markets are going. My opinion, it doesn't mean anything in the grand scheme of things. All right, so let's jump right in, and I'm going to share some charts with you as we go through this. So the first one I want to look at is the S&P 500 and the aggregate bond market index performance since 1990. So as you can see right here, the market, we had a big year last year, and the bond market had a little bit of a rebound as well, with a lot of it coming in the fourth quarter last year. But the S&P 500, if we go back all the way to 1990, it's amazing that there have only been 7 down years since 1990, and 3 of them happened in a row in 2000, 2001, and 2002. And you can see we had a lot of big years right before that, leading up to the tech bubble bursting. As we look at the last few years, 2022, it was a miserable year for both the stock and the bond market. As you can see, the bond market, which is this orange bar right here, this is the worst performance that it had over this entire period. And there have only been a few years where the bond market has been negative, right? We could count them here. 1, 2, 3, 4, 5 years that the bond market was negative since 1990. So overall, the stock market and the bond market have performed pretty well since 1990. Now this chart, this is what we call a quilt chart, where you can see the S&P 500 in red, the performance of the S&P throughout all of these years. And this blue one is if you had a balanced portfolio. So you could see the black line connecting it, where for most part it's in the middle because it's a balanced portfolio. And some things that stick out, like commodities, have been down close to the bottom for a long time. Fixed income down towards the bottom, and the S&P 500 has been towards the top. We've had a couple years where small cap has outperformed, like in 2020, 2016, 2013 was a big year for small cap, and 2010. But the S&P 500 has really performed well. And we don't know what's going to happen in the future. This is why it's very important to stay well diversified. Small cap could outperform this year, commodities could outperform this year, emerging markets could outperform. We just don't know. And because the S&P 500 has been so strong, markets typically revert to the mean, meaning that the S&P could very well not perform at the same level that it has been over the last few years, and we might play catch up with some of these other asset classes. Now here's another chart that I found interesting. This is different asset allocations and the performance since 2008. So as you can see, from 2008, we had the Great Recession, right? And then the market started going up from there, but it took all the way till about 2016, the end of 2016, before a 100% stock portfolio surpassed a 60-40 allocation. And then after that, it has been off to the races. So as you can see right here, this is where it surpassed that, and then 100% stock portfolio, it has just blown everybody else away, where 100% bonds has been down here. So if you started investing at the market bottom and you were 100% stocks, this is from going back from 2009, then you are up 327% in the 100% stock portfolio. Where if you're 100% bonds, you've only been up 58% over that same time period. And then you can see if you had a 60-40 portfolio, you've grown 214%. And if you have a 40-60 portfolio, then it grew 157%. So I found that interesting, that there was a period of time where they were all neck and neck competing with each other. And then at the end of 2016, US stock market, basically, it's just beat all the other asset classes by a lot during that time. In this chart here, this shows the performance of the Magnificent Seven since the beginning of 2020, where they have just blown everybody else away, right? So Meta, Amazon, Apple, Alphabet, Nvidia, Microsoft, and Tesla, they are up 271% since the beginning of 2020, compared to the NASDAQ, which is up 67%, and the S&P 500, which is up 48% during that time. So yes, if we all would have just bought the Magnificent Seven back in the beginning of 2020, we'd all be much happier and richer right now. And now with all the headwinds that this economy faces right now, being an election year, the chaos going on all over this world, there's so much doubt and uncertainty, and people are scared and they don't want to stay invested. This chart shows what would have happened if you bailed out of the market after the crash of 2009 and went to cash. So in one example, we show going to cash and never going back, where you would end up with $140,000. The next line, the yellow line, shows if you would have moved to cash for 1 year and waited for things to get better and then went back into the stock market. In that instance, your portfolio would have grown to about $500,000. And then the blue line, that just shows if you would have just done nothing and just stayed the course and buy and held, your portfolio would have grown to $821,000. So it's so hard to time these markets. And when the market is going down, yes, everybody's gut instinct says, get me out, I don't want to feel the pain. But history has taught us that it's typically the wrong thing to do. So now we find ourselves in a different predicament right now. The market's really at all-time highs. So it's not like you'd be selling out at a crash right now, which makes it a little bit more enticing, right? Where it's like, well, if I get now, I'm getting out before the crash, but we just don't know when that's going to happen. People felt that way a year ago in the beginning of 2023, thinking, you know what, this market's going to continue going down, get me out of here. And they missed a huge run up in the market. So if only it was that easy that we could all time the market and get out at the right times and then get back in at the right times. But now with that being said, is it smart to change your allocation, to maybe rebalance things a little bit and invest a little bit more in areas that you might be underinvested in? And to that, I say yes. And to being very well diversified as well, I always think that that is a smart move. Like, yes, you won't hit the home runs as if you just invested in the Magnificent Seven starting in 2020, but nobody knows what the next Magnificent Seven are going to be. So it's very hard to play that game. All right, so now this chart here, this is showing interest rates, the 10-year and the 2-year treasuries. And as you can see, we have a 42-year trend of declining interest rates. They hit that peak in the early 80s and we've been going down ever since. But this past year, we have felt the pain of rates rising. And here we are with a 10-year treasury around 4%, and everybody feels like rates are so high. But historically, they're not really that high. Where do they go from here? Nobody really knows. So if the interest rates, if the Fed starts lowering interest rates and we see the 10 years start to come down, that should be good for bond holdings, right? If you have a total bond market fund, it should perform well. If we see this 10-year go from 4% down to 3%, down to 2.5%, your bond portfolio will do well in that environment. But we all felt the pain like in 2022 when rates shot up and bond portfolios got obliterated. So right here, could rates go higher? They definitely could. We could see the 10-year go to 5%. Nobody really knows. Could it go back down to 3%? Yes, it could. But having bonds as an overall piece of your portfolio, depending on your age and your risk tolerance, it is a good thing to do. It does soften the blow in years of declining stock prices. And now what about developed and emerging markets? They've underperformed the US for a while now. Could that change? It's definitely a possibility. If you don't have any exposure to developed and emerging markets, it could be a time to add some of that because we just don't know what's going to happen in the future. And that goes for mid-cap and small-cap companies as well. They have not performed as good as the large cap, especially the large cap growth. So should you have a little bit more exposure than you have had over the last few years? And if you haven't touched your portfolio, if you haven't rebalanced it all, odds are the S&P 500, the large cap companies, is a larger percentage of what maybe you want it to be right now because it has continued to grow, taking up a larger percentage of the overall pie. So it's definitely worth looking at your account and thinking about rebalancing and adding to places that have not done as well over the last few years. And then what about commodities? Should you have more exposure to commodities in your portfolio? So they haven't had a great ride over the last 10 years. 2022 was a good year for commodities, but I would make the argument that I would like to have more commodities in my portfolio than maybe I did a year ago. And included in that is definitely something like gold. I like having gold in my portfolio. Here's a chart of gold since 2007, and you can see that it has underperformed the stock market. But here we are hanging out at all-time highs for gold, and it very well could break out from here, this position in this chart. So having small exposure to gold in your portfolio, I would say you don't want to have any more than 3 to 4% in your portfolio in something like gold, but I think there is a place for it just in case the dollar continues to go down in value and we see gold just explode higher with the deficit, everything going on in the world. I don't think gold is a bad thing to hold in your portfolio right now. And what about Bitcoin? right? We have the Bitcoin ETFs that were approved by the SEC. So now it's become very easy for everybody to own Bitcoin inside of their portfolios just by an exchange traded fund. So here's a quick chart showing Bitcoin versus the US dollar. So you can see when the dollar goes down, Bitcoin tends to go up. They typically have an inverse relationship. Now Bitcoin, just in 2023, it went all the way from 18,000 close to 50,000. So it has had a big run over the last year, but it hit a high of like 70,000 back in 2021. So it dropped almost 85%. I mean, it is very volatile, right? So you have to have the stomach for Bitcoin. But again, I don't think it's a bad idea to have small exposure to it inside of your accounts, just in case Bitcoin really does do what many people, many smart people out there believe that it could do and grow 10x from here. So if that's the case, you might want to have a small little bit of Bitcoin inside of your accounts so you could participate that if it does happen. But it has to be money that you're willing to lose. If we see Bitcoin go all the way back down to 15,000 or so, you don't want to have a huge percentage of your portfolio at that kind of risk. And then what about real estate? Do you want to have real estate in your portfolio? I would argue, yes, you do, through REITs, right? So having exposure to the commercial real estate market, residential real estate market, to the companies that invest in real estate, I think that it's good to have a portion of your portfolio, a small portion, invested in real estate, and that makes sense. You might know that I'm a big fan of owning physical real estate and owning rental properties. I like to take that approach. So yes, I do think you should have real estate in there as well. Here are some other sectors that pay high dividends that you might want to have exposure to inside of your portfolio, depending again on where you are in life, what your risk tolerance is, and all of that jazz. But as we can see here, energy, 3.7% dividend yield, utilities, real estate, consumer staples, materials, all of these have over a 2% dividend yield. So does this belong inside of your portfolio? Yes, I would make the argument that it does. So as you can see, when somebody asks me, where should you invest in 2024? My answer is everywhere. I think that you should own some of everything because we don't know what's going to do well, what's going to do bad. Do you want to be defensive? Maybe. It depends on your time horizon, what you're using the money for, your risk tolerance, and all of that. If we're talking 30 years out, then no, I'm not getting crazy defensive right here, even though I do believe that we could have a down year in the market or not a great year, but I'm not running for the hills because I'm not that smart. I don't know if that's going to happen or not, and I don't want to miss out if we do have growth because I have a very long time horizon. So even if we do have a down year, 2 down years, then that's okay because I have another 30 years. And as I go and I look back 50 years, I could see that a majority of the time the market is up. So I'm willing to live with the risk, with the roller coaster ride, with the ups and downs of the market, because over the long term, I'm confident that the US economy, that the world will still continue to grow, even though it feels like we're going to hell in a handbasket right now. I do believe that it will continue to grow, and I'm willing to put my money there for the long term. Well, that's it for this one. I hope that you found it helpful. Please make sure to hit that like button if you enjoyed it. Subscribe to the channel if you are not subscribed already, and I'll see you again in the next one. Thanks.